Hey guys. All right. So my name's Steven. I trade in the options cartel Discord with Sean and Will. As you guys may or may not have seen, I post my weekly scans in the expert plays section, and these are typically like journal entries that I do in my Trade Zella that kind of log not only what I'm looking at for the coming week, but they also kind of recap my week in review as well as my thoughts on the general market going forward, kind of like market breadth, structure, the health of the market, what are the leading themes and sectors and industry groups that I think are positioned to outperform. And then I look at all of this and try to formulate a trade plan, basically looking at not only the health of the market, but like I said, also individual names from a fundamental kind of CanSlim perspective, as well as technical trading plan that is very very similar, if not identical, to what I've learned from Sean. So these videos, or sorry, these trade plans that I post are quite long. They're quite lengthy, and I figured that doing videos is actually just a bit better way to kind of make this more accessible for people. They can listen to it, or they can watch it, listen to it in their car or whatever. So I'll just kind of dive right into it and start at the top. Looking at the SPY for last week. SPY broke out of its weekly base here. I'm going to turn these drawings back on, but if you look and see, SPY broke out of its weekly base on higher volume, which was a good look. I think that from a volume perspective, the SPY looks a bit healthier than the Qs. We did end up having a distribution day on Thursday, which was only the second distribution day for SPY. But on Friday, we did close the week at the highs after a gap up, and we held, kind of put in a doji candle on lower volume, which is kind of a good resting look for the SPY, but it is a bit extended from the 5 and 8 EMA. So we probably could see a little bit of like slowdown, a bit of digestion here would be healthy. From a volume perspective, like I said, I believe that the SPY looks a bit healthier than the Qs, and I'm going to tell you why. One is this. So if you look back here, this pink and blue line, these are the 100 and 200 day moving averages, respectively. On the 23rd, May 23rd, we pulled back here and bounced off of these, which is also kind of like the same spot as this 575 weekly support level. And that was not only there, but the 575 weekly support, but it was also the half gap fill. It was a 50% retracement on the Fibonacci extension, or Fibonacci retracement from this first higher low and to the move up, as well as the 100 and 200 moving average. So we kind of reset there, and that was a good breather for the SPY, and I think that's one of the reasons you're seeing continued push higher without some of the exhaustion signs that you may see from the NASDAQ. When you flip over to the Qs, you kind of see we've definitely got a bit more, definitely looks a bit more gassed in terms of the volume perspective. So, we have four distribution days, one that was on the May 21st, another one that's on May 22nd, immediately following, another one on May 29th, and then we put the last one in on Thursday. We've maintained the trend line going forward ever since, but this last distribution day that we put in on Thursday, I think, is largely a result. I think everybody knows is this, the kind of huge sell-off that we saw in Tesla, and this kind of brings me to my next point, which is that when you're looking at the NASDAQ and seeing that you've got these four distribution days, it gives me cause for concern too. I mean, I have a small SQQQ and dated QQQ put position just for a little bit of protection, because frankly it did look like we could continue get some selling here. But when you look under the hood and try to figure out where this selling is really coming from, you see that it's really not as bad as it seems. It's not like tech sector wide. If you look at the NASDAQ equal weight, you see that the volume profile, or the volume patterns, are actually a lot more constructive, because this huge distribution day that occurred on Thursday, we don't have that same kind of volume that we do on the Qs. On the Qs, that distribution day occurred on huge volume. On the NASDAQ equal weight, the QQQE, we don't see that. Why? Well, the reason why is because a lot of that selling uh, was heavily localized into Tesla, which makes sense. You know, the CEO is going to have a public meltdown and just kind of collapse in real time, lose a tremendous amount of market cap in a day. Yeah, if Tesla has a 9% weighting, I think it is. Let me tell you, I think it's if I have to look it up, Tesla has a yeah, no, it's sorry, it's only a 3% weighting, but still, nevertheless, 3% weighting in the Nasdaq. I was thinking of Nvidia, but 3% weighting in the Qs, you know, that's going to have a huge effect. And sometimes you get a bit of the tail wagging the dog effect too. Tesla starts to collapse, and then the Qs sell off. The Qs selling off causes Costco to sell, which Costco is, you know, got another 3% weighting in the Qs, which then causes the Qs to sell even more. And so, you know, it's a bit of a kind of a domino and tail wagging the dog effect. And then that's the reason why I don't think that we got much, really much follow through the following day. Even if you look at the Qs, you know, the next day we gapped up and, you know, kind of really kind of gapped up and opened at the previous day's open and held that move throughout the day, which was a good look. You look at the NASDAQ equal weight, you just don't see that kind of alarming selling volume here. And so I think that's a good look, particularly on the weekly. Weekly looks constructive. On the RSP, which is the S&P equal weight, you're seeing the same thing. It's actually an even better look. You know, we have this this EMA launchpad, the 5, 21, and 50 EMAs, all kind of curled up and converged here on the weekly chart, and the S&P, the RSP makes a big move with volume off that spot. I think this is a good look for the S&P going forward into the coming week. Looking at the IWM, I think, yeah, this is a fantastic look. You know, if you look on the, let's pull up this and look at the daily chart. We can kind of see this inverse head and shoulders here. This is a great look going forward. We've kind of basically filled this entire gap, which we had down until Friday, May 23rd, filled that gap, and then have pushed higher, consolidated above all of the key moving averages, above the 8, 21, and 50, and then we've pushed out. I did take a couple of stabs at IWM over 209, got stopped out on both of those, and then as you see, you know, we just on Friday, you know, gapped up, never gave you another shot to get back in, never retested, and just kept on going. But I do think this could be the start of like what everybody's saying is kind of a small cap summer, and I think that you will see a bit more health in this rally as you get more participation from the small and mid cap stocks. Going forward into Bitcoin, this is something, I'm not a big crypto trader. I don't trade crypto, but I do watch and look at the Bitcoin chart as just kind of a risk proxy. It kind of is a good indicator as to the market's appetite for risk. There are some crypto related names that I do like trading. CEP, MSTR, for example, Hood, Coin. And I think this is a good look. This OOPS reversal on Friday the 6th, kind of hammering right off the 50 EMA, which was you know, basically put in a hammer candle on the weekly chart off the 8 EMA. Lower volume, but improves the momentum. I think this is a good look. I think that, you know, over 107, this is constructive to look to a move into previous all-time highs and hopefully new all-time highs. But you see, as you know, as we kind of bounced off the 50 EMA here, we reclaimed the converging 9 and 21 or 8 and 21 EMAs and push. That's going to set us up for a good move higher. Touched on the equal weight RSP and the NASDAQ. One thing that I also look at too is the percentage of stocks above key moving averages. I don't know if people track this, but I certainly do, because I think it's a good indicator of market participation. If you zoom out, you can see that this is like a range bound indicator, right? Just kind of moves in this range. And I've notated here, you know, in both in terms of like the color of these lines and the thickness of these lines, like the importance here, because the market, when it gets too extended to one side or the other, it's going to tend to mean revert. And when you're seeing is, right here when we got around the April 7th mark, that was a ton of stocks that were below their 200-day moving averages. And when we got the 90-day tariff pause, this pushes us up higher, and we're starting to see that now we're right around 44% of stocks above their 200-day moving averages. Ideally, where this is really going to be look really healthy is when we kind of get above the 50% line, and when we live somewhere between 50 and 65% is really when that's a lot of stocks participating above their key 200-day moving average, and it's not so many that the market is frothy, but you want enough stocks above their 200-day moving average that things are in an uptrend. What you can start to see now, though, is that if you look at the shorter term bias, the 50-day and the 20-day, we got about 70%, 73% of stocks above their 50-day, and about 60% of stocks above their 20-day. And so this is probably this number having gone down in the recent weeks, or the recent week, is likely a result of kind of some of that selling that we did see as a result of that distribution day on tech, Tesla selling off, that probably pushed this number down. But what you're seeing is that in the nearer term, some of the shorter term moving averages, the 50 and the 200, the 50 and the 20, we got a lot of stocks above that. So this is kind of telling me that there's we're starting to see stocks that weren't participating in the early part of this rally start to curl up, and then once those names get above their 200, that's when this is going to start to look like we've got a lot of participation going forward. Looking at the VIX and the UVXY. This is not what you want to see if you're a bear, right? We pushed up higher on that big sell-off day on Thursday. Like I said, I was really catalyzed by the move in Tesla, and we couldn't reclaim or hold above the ADMA. If you're a bear, if you think about the daily sequence of this, you want to see this really bullish move off the lows with volume. You want to see continuation on that. And the fact that we couldn't continue to push the VIX higher is really kind of an indication there's just not a lot of sustained power or conviction from the bears. We immediately sold off on this candle and pushed down towards the lows again. I would say that in the near term, I'm going to probably put an alert here on this for myself, is that I would want to be aware when the VIX or the UVXY, I prefer to use the UVXY because it has volume as opposed to the VIX, which doesn't show volume. But I would start to look and want to know when the UVXY starts to approach 1950, because I really think that we would probably start to see a technical bounce there, and that might be a good indicator that we might start getting a bit of a pull in on the indices and some individual names. Other risk-off indicators, a bit of a concern that the 10-year poked up about above 4.5. This happened on Friday. So there's so many other good things happening in the market that look really bullish, but this is something to be concerned about, right? Because as this starts to move up, and particularly, I mean, if you're looking at it on the weekly chart, that's a bullish look on the weekly for the 10-year. And if this starts to move up into 4.6, 4.7, that's really when we're going to start to see it put more pressure on equities. So this is a helpful thing to keep an eye on. It doesn't mean to panic right now. The market is, as I can tell, is innocent until proven guilty. This looks good, but this is something to keep my eye on. Another thing that I was keeping my eye on that was giving me a lot of concern was the setup in gold. Gold looked incredibly bullish into last week. Kind of was getting over this my appropriately titled threshold here, and you can see that not only did we fail the first time, this was last week, or sorry, so 2 weeks ago, when we finally got over this this kind of pivot area, we failed the very next day. We consolidated again above the moving averages, pushed higher, and then failed again. And if you're long tech or more speculative names, this is sort of the thing you want to see, right? There were some other names that I was tracking, like Orla. You can see, I wanted to get long this name here, missed it because it gapped up. It just made a monster move and then immediately failed on Friday, which again, great news if you're long tech or other speculative equities. Other names like Royal Gold, other names like Royal Gold did the same thing. Breakout, consolidated. This looked like it was getting ready to make a move higher, failed. This is exactly what you want to see if you are, like I said, long tech or some other names like that. The move in silver also, this is the one, like I said, gold is starting to fail, but the move in silver is also concerning. Silver generally is like kind of lags behind gold a little bit. Gold will generally tend to make its move first, and then silver is a little bit further behind. Silver is definitely surging right now. And so, some of these mining names, it's no surprise why these have been like top of the list in terms of like industry group relative strength. The miners have been. And so when you start to see these moves in gold and silver, it's no surprise as to why. So this is another thing I'm keeping on my list. If this move sustains, I like a name like PAAS, Pan American Silver Corp. I'm certainly not going to buy it here, but it's super extended, and even from the 5 EMA, I think this is like if I looked up the ATR, 3.5% ATR. Yeah, this is like it's like two ADR. 2 ATR away from the even the 8 EMA, so there's no way I'm buying that there. But moving on. Another thing that I have been keeping my eye on is a bit concerning, or was a bit concerning, was the US JPY, the yen. Kept an eye on this. I am not an economist, right? I'm definitely not an economist. I am not an incredible macro trader like a Soros or a Besant. But what I do know is that back here on the weekly chart, if you go all the way back to August 5th when the carry trade flash crash happened, this is the level, the 144 to 142, 140-ish area, that when the yen hit that is what kind of caused the liquidation that kind of carried forward into equities, and we got this massive dump in U.S. stocks because of the yen carry trade collapse. If you want to look up more about that, there's plenty of videos. I'm not the best one to explain it, but this is something that I keep an eye on. I don't know if this level correlates with another risk to the carry trade, but I do know that this is the level that we got to when that collapse happened, and so I do keep an eye on it for that reason, right? For what it's worth, we did bounce off that level, and we have been putting in higher lows. And so now we're kind of starting to move up again. So if this is an indicator as to the health of like the risk on appetite for the market, which is like the carry trade is absolutely a risk, like a risk on trade, then if this is moving forward and moving in the right direction, then that should be good for risk names going forward. So moving ahead, trying to look at some sectors and leading industry groups. I'll pull up my sector ETF list, and so some of the ones that stood out to me, XAR. This is the aerospace and defense ETF. This one is super strong on the weekly chart. You can see just kind of, we've even gotten some separation here from some extension from even the 5 EMA on the weekly. We got a blue dot in terms of the relative strength line on the daily. Like this is going to be something that this to me means aerospace and defense stocks, if they're not extended and they are setting up from a technically sound perspective, and they are it is a name that from a fundamentals perspective that I want to be involved in, this should mean that these names are at the top of my watch list. Another one that's setting up is XLC, the communications ETF. This is again setting up really bullish on the weekly, breaking out on the daily chart. RS line peaking up. This means the communications names are going to have my attention. Same thing with industrials. This is setting up super bullish. Anything in the industrial sector is probably going to be a good look as a result. Financials, the XLF. Shouldn't be any surprise when you see a setup like this with with just a pullback into the EMAs, setting up and basing right there on a key level, holding the 21 EMA and starting to break out with the relative strength line peaking up, and the weekly chart being set up in just like, what was this? It's like they're not inside. It was basically 2 inside weeks on this mother candle here, but yeah, it shouldn't be a surprise why there's so many great setups in banks. Banks, investment banks, and brokers all look really good. There's a few of them on my watch list. I can go through that. And then XLK, the probably the most important ETF in the SPY or in the market, is the XLK, the technology ETF, and this is looking pretty good. Giant cup and handle on the daily. Pulled back into the base to test the 200 moving average, reclaimed the 8 EMA on the daily, and then positioning for a breaking out higher. Relative strength line ticking up. This is exactly what you want to see if you're long speculative tech names. Another good thing, some weakness in the XLP, the consumer staples ETF. You have to go all the way down here to see the relative strength line. But this relative strength line curling down, pushing down is exactly what you want to see if you're trying to, like you said, get involved in some of these more risk-on names. Consumer staples, just to give you an idea of what this is like the Walmarts, the Costco's, the Procter & Gamble's, the Johnson & Johnson's of the world. These are the names where money goes to hide. Big institutions, institutions are what move the market, right? And institutions are not like you and me and the people that are watching this video. They can't just go to cash, right? They are mandated to be fully invested or nearly fully invested at all times. And so if there's weakness in the economy, perceived weakness in the market, they can't just go to cash. They have to pull their money out of one sector and rotate it into another sector. And so this is typically where that money goes when things are looking scary. And so seeing this sector of the market being weak is a good thing for the broader health of the market and a push higher.